We see Tesla shares under a little bit of pressure, but this after the company out last night, beating on the top and the bottom line. Of course, the broader market, as we can also see on our screen, in the red as we get today's trading session underway, coming off that record close yesterday. Joining us now to talk a little bit more about Tesla's most recent quarter is Emmanuel Rosner, lead auto and auto technology analyst over at Deutsche Bank. So let's just start with how you guys are thinking about the most recent quarter for Tesla in a world where every company is talking about chip shortages and Tesla, as they outlined last night, managing to come through that in pretty decent shape.
Yes, thanks for having me. We thought it was very, very impressive. I think investors' expectations were actually quite high going into the quarter, thinking they could beat, but that would have been based on pricing. In fact, where they actually beat was on the cost performance. The gross margins were really strong, 3 full points ahead of where the street and we were. And that really reflects relentless focus on improving the unit economics, essentially making the cost of these electric vehicles lower and lower, even versus last quarter. It's just an extremely impressive achievement. And so they really beat on cost performance. That's something that really showcases the lead that they have versus the competition. 15% operating margin, excluding stock-based compensation. That's best in class in the automotive industry, and especially at the mass market level. So we truly think this is about their low cost. This is about the superiority in battery technology, and it seems like there's quite a bit more to come in 2022.
Emmanuel, Elon joked a little bit about this on the earnings call last night about potentially building a chip factory, on why that would take a long time, but if the electric cars are in fact the future and they're going to ramp up production of more vehicles outside of their sedans, why shouldn't they build their own chip-making facility?
I think that there's a few things. I think that Tesla has obviously their hands very full between the amount of additional vehicle capacity they're adding with Austin as well as Berlin, all ramping up on track to be before the end of this year. That will add tremendous amount of vehicle capacity. And they're also ramping up their own battery cells capacity, which will start next year and potentially reach 100 gigawatt hours or so before the end of 2022. So this is already a tremendous amount of effort, should support a very large amount of growth. Obviously, this is supported by a fairly efficient use of capital. But I think everything is essentially this kind of choice. You sort of have to ensure you're able to support the growth, but at the same time, you also have to see where it makes the most sense to invest your capital. I would say, back to your earlier comment, Tesla has done a spectacular job in the second quarter in a very, very challenging supply chain environment to actually produce as much as they possibly can, almost maximizing capacity utilization. So this has actually probably been one of the toughest quarters from a supply chain, especially semiconductor. They manage actually quite well, very, very nimbly. And so maybe it's just not their first priority.
Emmanuel, it's Julie here. It feels like Tesla has sort of hit another maturation phase, right? That they are sort of have hit benchmarks like you're talking about in terms of cost control. What do you think is the long-term sales growth of this company, this is sort of sustainable sales growth?
So it's interesting, because I think we're going to see an acceleration before the maturation phase that you actually speak about. I think this is where investors are maybe not paying full attention here, but next year's growth, so 2022, will likely be north of 50%, potential upside all the way to 100%. If you see the amount of capacity that's already on the ground, that's probably 1.1 million units. And then they're adding 2 additional factories, which will be done before the end of this year. That probably takes their capacity to 1.7 million units. That's close to a doubling in terms versus the production expected this year. And Elon Musk also said on the call yesterday that they've ordered a doubling in terms of number of cells they're going to get, battery cells they're going to get from suppliers. So they're certainly planning for potential doubling of their volume in 2022. I think the street is well below that. So are we for now, conservatively, but there's quite a bit of upside. So I would say there will definitely be a mature phase. I think this is not it for now. I think that between the new plants as well as the new products, Cybertruck, semis, I think that we're going to see an acceleration as you move into 2022. Beyond that, Tesla's view obviously is about a 50% CAGR. That's probably made up of some above average years like next year and even this year, and then some lower average, we probably have them at about 30% or so on an ongoing basis. But that's just from the vehicles. When you sort of see also the opportunity for other areas of the business as well as software, I think they could still do much better on the earnings growth front.
Elon saying that he will no longer be no longer going to be on the earnings calls. Is that him signaling that perhaps he's starting to think more about succession planning, and then he has to let these other executives shine, and then ultimately he may follow the Jeff Bezos route, and perhaps he could be the executive chairman within 5 years?
Yeah, I think that's a great question. I think it's a very, very clear possibility. From the outside, it seems his involvement has never been higher. So he's still involved in every single detail, still involved in every single decision. He portrayed this decision no longer to be on the earnings call, more as an efficient use of time. If it's just to answer analyst questions, a lot of people are very qualified to do it. He would still be running the company. But yeah, we can't help but think that obviously you need to sort of continue nurturing talent, making sure that this is a company that's sustainable, even when he's not doing everything on a day-to-day basis. And so that's probably part of this natural progression. I don't think that this is something that's imminent. I think that in the near term, it's really mostly about getting back some of his time so he could work on the multiple project. Longer term, yeah, absolutely. The fact that Tesla could do well without him, or at least without his day-to-day involvement, would actually be a very, very positive for the stock.
All right, we'll leave it there. Emmanuel Rosner, lead auto and auto technology analyst over at Deutsche Bank. Thanks so much for jumping on this morning.
Thanks for having me.